Good afternoon, everyone. How's everyone doing today? It's a beautiful day in Ontario. Fortunately, the Blue Jays have stopped playing, but the Leafs will soon start playing. I'm a Canadiens and a Canucks fan, so I'll be rooting against the Leafs, sorry to say. I was born in Montreal, I grew up in Vancouver, and I learned to hate the Leafs. Thank you very much. Thank you, Vanda, for the kind introduction, and I look forward to chatting with Sonia in a few minutes. GRI does extraordinarily important work for our country. It really adds to brand Canada. We do financial services very well in Canada. I think that would be a global consensus view. So great organizations like the GRI are part of that brand and part of that capability. I hope OSFI is seen that way, and we certainly strive to do that every day. So before Sonia and I jump into questions, I have some remarks. But before I begin, let me acknowledge that we meet today on the traditional land of the Mississaugas of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, the Wendat peoples, and the home to many First Nations, Inuit, and Métis peoples. Earlier this week, we commemorated our National Day for Truth and Reconciliation, and we remain mindful of the Truth and Reconciliation Commission of Canada's 94 calls to action. Turning to the topic of my speech, it will be about a topic that I think a great many people have been interested in, and that is bank capital, and particularly the bank capital requirements for Canada's systemically important banks. So to start, 2024 has turned out to be an interesting year, interesting in the old Chinese proverb. We continue to garner much attention in the areas of underwriting, mortgage underwriting, the integrity and security component of our mandate, climate risk management, and the prospects for financial system resilience in an era of intensifying uncertainty. Sonia and I are going to discuss some of these topics in a few minutes, but I must say the intensity of attention is new to OSFI and gives us an opportunity to communicate more clearly to Canadians about how we serve them. As I mentioned at the start, one area that has garnered an extraordinary amount of attention is OSFI's implementation of the 2017 reforms to the Basel III framework for the prudential regulation of banks. This we call the 2017 Basel III reforms. It also goes by the nicknames Basel III Endgame, Basel 3.1, and Basel IV. We go back to the original text in 2017, and we call it the 2017 Basel III reforms. We were not alone in attracting this attention. In a neighboring country earlier this year, one could find a great deal of public attention on the 2017 Basel III reforms, most peculiarly on television advertisement and airport billboards. And as regulators, we have a new audience with whom to communicate, populated by thousands of well-intentioned, curious inquisitors about how bank regulations and bank regulators might affect their businesses and their economic opportunities. So for this reason, I thought it would be helpful to address our approach to the 2017 Basel III reforms. So in 2017, we committed to implementing a series of post-financial crisis regulatory reforms to the Basel III framework. And we were joined with supervisors from 20 participating jurisdictions who are part of the Basel Committee for Banking Supervision. We made this commitment to make the Canadian banking system safer and to signal our willingness to contribute to international financial stability. So we set about diligently making good on our commitment. And because Canada has a principles-based regulatory framework and culture, we're nearly finished with the commitment. While some of our peer signatories to these reforms inconveniently have further progress to make. Observers can track Canada's implementation lead at the Basel Committee on Banking Supervision's website. And in the text of this speech, the link is right there. So I would note that a number of our peers this fall have reaffirmed their intent to fully meet their commitments to the 2017 Basel III reforms, but with timelines that extend to the later years of this decade and the early years of the next decade. Given the widening of Canada's implementation lead, OSFI slowed the implementation of the last element of the Basel III reforms in 2017. And we call this the now legendary capital floor. As announced in July 2024, OSFI put in place a one-year delay to the increase in the capital floor level. As a result, the minimum floor for risk-weighted assets calculated by those banks approved for internal ratings-based approaches to risk weighting, as opposed to the standardized approach, will rise more slowly than initially anticipated. Presently, the capital floor that a bank's RWA calculated with internal models must total at least 67.5% of risk-weighted assets calculated under the standardized approach. That floor will rise to 72.5% in 2027 on the current schedule, including the aforementioned one-year delay. Of note, and to clarify, only Canada's 6 domestic systemically important banks, which I will call DSIBs, have approval to use IRB approaches to calculate RWAs. In the course of arriving at our one-year delay, we received a great deal of interest and a great deal of argumentation regarding the impact of this technical change to a complex regulatory capital ratio. In fact, we were surprised by the stakes in which some observers set their argumentation. Some argued that OSFI's decision on this technical calculation method would have a consequential and negative impact on economic growth, arguing that dramatically rising capital requirements would slow lending and then slow economic growth. So we welcomed that challenge because we believe it important to constantly test our thinking to ensure our well-intentioned efforts to enhance resilience in the Canadian banking sector do not lead to unintended consequences. So in that spirit, I'd like to offer a few observations on this question. Observation number 1, the 2017 Basel III reforms do not have a material effect on DSIB capital. Well, based on our estimates, the implementation of the 2017 Basel III reforms in Canada is expected to be capital neutral, even at the fully phased-in level of 72.5%. While there are many moving parts to the full suite of Basel III reforms, the two most impactful components of those reforms on bank capital levels were, 1, the removal of the 1.06 scaling factor that was previously applied to modeled RWA, and 2, the inclusion of the capital floor discussed above. According to public disclosures, aggregate modeled RWA of domestic systemically important banks was roughly $1.5 trillion at Q2 2024, which suggests the removal of the 1.06 scaling factor provided immediate relief of roughly $90 billion in risk-weighted assets, i.e. 6% of 1.5 trillion, ranging from 4.8 billion to 23.4 billion at each of the DSIBs. Using information from DSIB's Q2 2024 public disclosures, along with regulatory data publicly available on our website, we estimate the increase in RWA due to the fully phased-in capital floor to be approximately $85 billion compared to the $95 billion in capital release. This has an impact on banks' common equity tier 1 ratio, ranging from 0 basis points to 86 basis points for each DSIB. As outlined in our calculation of the capital floor, a detailed outline of our calculation of the capital floor can be found in a technical note published on our website today. In other words, the numbers I just provided you, we do have empirical backup for, and it's available on our website. So the impact, the capital floor impact on a gross basis, ignoring the impact of the prior capital relief at $85 billion, is many multiples lower than some estimates and is negligible on a net basis. So point number 2, the benefits of healthy surpluses in bank capital have outweighed the costs. So underlining criticisms of banking regulators seeking to add to banks' capital surplus is an argument that high and rising capital requirements increase the cost of lending, which in turn slows economic growth. I think it important that OSFI always keeps this argument in the forefront of our minds when we make technical decisions about bank capital calculations, lest we trigger the unintended consequence of damaging economic growth through an excessive concentration on financial resilience. A colleague of ours from the Bank of England, Sarah Breeden, a Deputy Governor for Financial Stability, presented a speech this fall in which she made the following points. She reminded colleagues that the purpose of bank regulation is to ensure that the banking system provides vital services even as shocks occur. She also warned that bank regulators must avoid, and I quote her directly, the stability of the graveyard, taking care to respond to opportunities to increase growth potential without undermining financial stability. We at OSFI think this is a great articulation of the proper risk appetite for bank regulators. There is an optimum level of bank capital, one that lessens the likelihood that a financial shock damages the economy, but avoids the stability of the graveyard, in Sarah's words, in which economic growth is unnecessarily slowed by an excessive aversion to financial system risk. Central bankers and academic researchers have found fertile ground for studying this trade-off since the global financial crisis. This has included researchers from multiple Federal Reserve banks, the Bank of England, the Bank for International Settlements, our own Bank of Canada, and many universities. And while there are legitimate research debates, there is a general consensus that the benefits of rising capital requirements after 2009 in reducing the probability of financial system shocks have outweighed the costs of slower lending as capital requirements rose. Second point, there is an optimum level of common equity tier 1 capital relative to risk-weighted assets that runs in the range of 10% to 15% if banking systems have advanced mechanisms for bank resolution and contingent capital available for conversion to common equity in a crisis. Increases in bank capital requirements should occur gradually to avoid more serious unintended consequences on economic growth. When capital requirements do rise, those banks with thinner capital surpluses to regulatory capital minimums tend to lose market share, while those with higher surpluses tend to gain market share. And finally, this market share transference tends to lessen a system-wide drop in credit availability during periods of gradually rising bank capital requirements. In other words, surplus capital steals share, or banks with surplus capital steal share from banks without surplus capital. Third and final argument, the capital floor adds model risk discipline and competitive balance to Canadian banking. Internal ratings-based approaches to risk weighting incorporate an individual bank's own historic losses. But past performance is no guarantee of future performance, and as the global financial crisis teaches, decades of strong loss performance can evaporate suddenly. Moreover, periods of low loan losses result in higher calculated capital ratios in good times and lower calculated capital ratios in bad times, as losses rise and are incorporated into internal models. A capital floor will cause banks to more regularly investigate, challenge, and improve the assumptions in their internal models, lest the standardized floor become binding. In this way, the capital floor introduces more model risk discipline into the banking system. The capital floor also has the benefit of reducing the difference between capital requirements for banks using internal ratings-based approaches and banks using standardized approaches to risk weighting. This will tend to add competitive balance, all else equal, which we believe ultimately benefits Canadian businesses and households looking to finance their futures. So, in conclusion, I am sure some observers may wonder what this argument means for the schedule OSFI pursues in regards to the capital floor. The honest answer is that we don't have to make that decision now, so we will not. I expect sometime early next summer, we will announce our path forward with or without changes to the schedule. But I will say that despite Canada's demonstrated commitment to the 2017 Basel III reforms, we cannot extend the implementation lead we share with a small number of fellow signatories. The Basel III 2017 reforms will strengthen banks' ability to withstand financial shocks and support economic growth while enabling them to compete and take reasonable risks. Key to these reforms' success is full, timely, and consistent adoption and implementation across Basel Committee and banking supervision jurisdictions so that competitive balance prevails throughout the international banking system. We will continue to measure implementation progress of the 2017 Basel III reforms across other jurisdictions with a focus on both competitive balance in banking and the soundness of Canada's capital regime. That's all I have to say about capital. And Sonia, would you want to start with the questions? Thank you.
Thank you for those comments. I'm sure that there will be lots of questions flowing into my iPad shortly. So I will wait for them to come. Other than to, this is our 4th year of meeting here at the GRI Summit. So maybe I'm going to take the liberty to be a bit provocative on my opening question. And I find it interesting that prudential regulators are placing as much emphasis today on this notion of economic growth versus bank resilience. And that feels like something I haven't historically heard prudential regulators talk about. In fact, as I recall it, when I was in an active bank role, I recall that provincial regulators didn't really care much about economic growth, and it was all about resilience. So I'm just interested in the change in tone and how we should interpret that and what that means in terms of a bank making a case for economic growth, particularly in times where you might consider the environment to be a challenging environment and may want capital constraints to be tightened, potentially?
It's a great question. It's a product, the question itself is a product of the success we've had since the global financial crisis. And as evidence of that success, we got through 2023. That was a pretty major shock. We had significant bank failures on both sides of the Atlantic, no recession, no real spike in unemployment. The system held in really well. Even going back beyond that, we operated quite ably through the initial shock from COVID-19, the March 2020 flash crash. So we're imperfect, but I think we have achieved a lot over the last 15 years following the financial crisis. And there's this natural tendency to want to do more. Someone giving me advice when I first took the job said, the superintendent is there to take the blame if a bank fails. I don't really believe that, and it was said in jest, so I don't want to overstate that. But there is that natural tendency as a regulator to think, if I'm not on it and I let a financial institution fail, it's all my fault. So therefore, I have to do everything I can to prevent that. And as we moved our buffers up over the course of the last 15 years, we began to, in addition to creating resilience, we began to press into the growth dreams and ambitions and strategies of the institutions we regulate. And they have begun to say, wait, enough's enough. If you keep going further, we may not be able to lend as much as you would have liked. Or maybe our deposit gathering or funding strategies will have to change in a way that harms economic growth. And so we have to listen to that. An enlightened bank regulator knows that prudential health of a system is enhanced dramatically by a healthy economy that grows through economic cycles.
Thank you. Thanks very much. So let me lean from there into something I know is uppermost in many of our members' minds, and that's the housing market and mortgages. With the loan-to-income ratio, which will come into effect in the first quarter of 25, intended to backstop the MQR. And given this new requirement and the expectations of financial institutions, how are you viewing this in terms of its effect on the housing market and the MQR going forward?
Yeah, so it's a great question. Thanks for asking. On the MQR and the loan-to-income test, I'd like to start with the MQR. We've had it in place since about the start of 2018. It has certainly added a bit more discipline to underwriting in the form of testing household income resilience to rising interest rates. However, there are two challenges with respect to the MQR. The first one is that it really didn't stop a very substantial buildup in mortgages with very high loan-to-income ratios, which I define as 450% loan-to-income and greater. And that, unfortunately, during COVID, that big block of very highly leveraged mortgages also happened to be weighted towards variable rate products that had fixed payment components to it, which we see as a manageable but serious risk concentration. And for all the work we put in the MQR, I would have rather had that risk concentration not emerge. That's the first challenge. The second challenge is, by virtue of the way it is implemented, which is at the institution to borrower level, it feels to the borrower like it's OSFI regulating them individually. It's not the intent. I could read out B20 and argue that we actually only regulate institutions and not the borrowers. But if you're walking into your branch down on Main Street on a Saturday afternoon to talk about renewing your mortgage or getting a new one, it feels like OSFI is regulating you. And that is not the intent Parliament has ever set for OSFI. OSFI's job is to regulate financial institutions, not Canadians. But the MQR creates that perception, and I think that is a challenge to it. So, with those challenges in mind, stealing from our peer regulators in other jurisdictions, and particularly the United Kingdom, we looked at this loan-to-income test. And the loan-to-income test is pretty simple. It says every quarter, a bank or a lender can only lend 15% of their mortgages in that quarter to borrowers with loan-to-incomes higher than 450%. That is a very effective ceiling that stops the build of risk concentration. Now, when we looked at that and tested it out here, we learned that it wouldn't work, a single 15% ceiling or 20% ceiling across the industry wouldn't work. And so what we determined is that we would do it on a bespoke model. We would go institution by institution and calibrate it to those business models. And our back testing on that method tells us that it would have eliminated or at least severely blunted this risk concentration I earlier mentioned, and it does not involve the borrower at all. It is a direct regulator to financial institution metric. So we're going to test it next year, and if it works the way we want, and we'll probably have to, tighten or loosen the bolts here and there, but if it works the way we expect it to, then it is a legitimate alternative or a legitimate complement to the MQR. And we'll make that decision after we have a full year of testing to make sure if we do anything, we do it right.
So let me just have a little bit of a follow-up on that. If you find, if the feeling is that it's too negatively impacting the end consumer, the borrower, is that a factor that you will take into account in terms of reevaluating whether it's working or not working? So if it's affecting the housing market in that way, is that a criteria that you will use to assess it?
It won't be the direct criteria. Well, the direct criteria we'll assess is whether underwriting remains sound. Okay. However, indirectly, enlightened self-interests would tell us overall value of collateral. If you had a sudden and volatile shift down in the overall value of collateral, that would weaken credit quality and weaken capitalization in the system.
Right.
We should consider that reality and make informed decisions primarily focused on our mandate directly, but not blind to the indirect factors that can affect the MQR, or the application of sound underwriting to the mortgage industry. And yes, the way Canadians feel, OSFI's presence through the MQR is a factor. And to cite an example, we recently, through to much fanfare, stopped requiring institutions to apply the mortgage stress test, or MQR, when uninsured borrowers switch their mortgages straight from one lender to another. In other words, the amortization doesn't change and the mortgage loan owing doesn't change. It's a straight switch. And we said, when that happens, uninsured or lenders need no longer apply stress test to uninsured lenders, at least insofar as OSFI is concerned. They may still choose to do that. And we did that because, by the way, straight switches are, before the MQR came in, were 2 to 6% of renewals. After the MQR came in 2018, they were 2 to 6%, varied. So 95% of Canadians don't switch their mortgages. So it wasn't a huge Prudential issue. But if I were a Canadian and I had a variable rate mortgage with a fixed payment and I was going to get it renewed in a year, and my mortgage balance was higher because it's negatively amortizing, and the mortgage rate was going to be higher, and therefore I was going to be stress tested at a much higher level, I'd feel like the presence of the OSFI stress test would bar my ability to get a mortgage. And that did make a difference in our decision making. Even though it was only going to be a limited number of Canadians, I don't think that that's OSFI's role and purpose. And I think doing that or accepting that does undermine confidence in our institution. And that was a factor. And I do think my lesson learned over the first 3 years is that institutions with unelected public servants who serve a government elected by the populace must stay within their mandate outlined by Parliament and must be very careful not to go out it, lest they undermine confidence in their institution.
Great, thank you, Peter. Let me move to the macroeconomic environment and financial resiliency. So if we just take a look at the current set of circumstances, Bank of Canada's reduced its rate by 75 basis points so far in the last few months. More to come, likely. At the same time, consumer spending's weak, unemployment inching up slowly, job gains are primarily in the public sector, and the business investment sector's not strong. So given all of these macro conditions, how are you viewing the resilience of the financial system as a whole? And how does this fit in, and how do you think about this in the context of your 24-25 annual risk outlook?
We just issued our update to our semi-annual update, and the risk didn't change. It's residential mortgage risk, commercial real estate, liquidity, and then integrity and security in a world of intensifying geopolitical risk. So what we're seeing, and I'm touching wood here, is globally and locally successful lowering of inflation, which is a long-term economic threat to our ability to sustainably grow as an economy. So that's really good news. And I think achieving that will have a confidence-building effect. And I'm quite optimistic. When I don't have my superintendent hat on, I'm quite optimistic about the future. When I put my superintendent hat on, I'm paid to be, if not pessimistic, at least healthily paranoid. And the areas where I feel a little bit of appropriate caution and even fear are areas that we don't see as well into, our risk areas where our view into those risks are more opaque. And where is that? The changing geopolitical environment are creating new risks that we're not familiar seeing, and then even when we do see them, they're hard to look into and sort through. Cyber risk would be a good example. How do I measure the likelihood that a financial institution will be hit by a cyber attack? I can measure how well they've built their defenses, but I can't determine how effective the cyber attacks will be until they actually happen. AML risk, anti-money laundering risk, that isn't only a problem related to the proceeds of crime in a local context. That is a problem that has a transnational factor associated with it. And it's a risk that is more significant than I appreciated 3 years ago when I started the job. The final one is hard to see in, is probably the biggest one, is the risks that come from non-bank financial institutions. So one of the consequences of stronger, more resilient banking systems is the emergence of non-bank financial institutions that provide intermediary services. Some are highly regulated, like life insurance companies or other insurance companies. Some are not very highly regulated, for example, hedge funds or private equity funds or private credit funds. Usually, when you get fast growth in a lightly regulated space of the financial services corner, there's a crisis and an accident that undermines broader systemic stability. I'm not predicting that, but I'm worried about it.
So if let's just spend a minute on the whole. We just had a breakout session on private credit, and I wasn't able to make it to the whole session because I was rotating through them. But the tail end, I think what I heard is there's no risks, there's no reason to regulate, and no reason to look in our direction. I don't know if there was something before the end part that I heard, but how do you react to that?
Sounds a lot like securitization of subprime mortgages in 2005.
All right, good enough. If we just go back a little, I've got a question here that's come in. Would OSFI contemplate to remove the stress testing requirement totally if, when they introduce the new loan-to-income potential concentration requirements along with all other regulatory requirements? Is that something you anticipate going away?
The honest answer is I don't know. That's what we need the next year to figure out. We designed the LTI to be either a complement or an alternative to the MQR. And we need a year to really put it in place and then measure whether we're getting the effects we want. That's the responsible way to do it.
Okay. So let's move a little to the whole area of concentration risk. we don't have, compared to many other markets, we haven't had as many financial institutions, but we've seen consolidation, HSBC, CWB. We have a very, in terms of, there's lots of very small organizations, but in terms of that second tier, the medium tier, it's shrinking quite significantly. Credit union consolidation. So how do you view this in terms of this growing market share and the growing dependence on fewer institutions and arguably less competition in the Canadian market? Is that a concern
It is.
Okay.
And, a lot of the argument I just made about the capital floor, part of it may be better to say than a lot. Part of the argument I made about the capital floor was if the capital floor, or as it comes into force, it does rebalance relative capital, relative risk weightings between systemically important banks on the internal-based, ratings-based approach and smaller banks on the standardized approach. There is a fairly significant difference in risk weightings between those two approaches that, all else equal, if you talk to standardized banks, disadvantages standardized banks and advantages internal ratings-based banks. And when you have those imbalances left unaddressed, they can produce adverse selection in terms of risk. And even though we don't have a competitive mandate, a prudential mandate still merits thinking about that imbalance and trying to level it. And there are multiple ways to do it. The standardized floor is one. And the other way to do it is to consult with our regulated constituents who are on the standardized approach to see how we might put in place a made-in-Canada improvement in the standardized approach that maybe also helps level that playing field.
Very good. And do you, from your point of view, and maybe this isn't a fair question to ask you, Peter, but do you think we've gone too far? Do you think we've gone far enough? Do you think we're in the right place? Do you have a view on future consolidation?
So I'm going to try and dodge that question. First of all, any views I'd give to the minister as advice to minister, and it would undermine my responsibility if I were to really be transparent on that. I do think Canada's system, as it stands now, with 6 systemically important banks, which is a lot for a country our size, certainly a lot more than some other systems. And I recognize the consolidation pressures, but there are still really cool, innovative, challenging institutions in the market that are competing and generating good capital return. I like the industry structure prudentially. I think that, and it, last 30 years bears it out. We haven't had a bank failure. So I like the status quo.
Great.
Prudentially. I like the status quo prudentially.
All right. Thank you. Let's move to integrity and security. New mandate for OSFI. You've mentioned a number of times that this is a more material issue than you had originally thought. And I think we're seeing evidence of the challenges in relation to this. Do you view it as in any way, do you view it as going to make Canada more competitive or less competitive?
Well, the Canadian banking system or Canada overall?
Banking system, sorry. Yeah, I'll stick to the banking system.
So, yes to both. So, we are, by virtue of the way our mandate has been changed, a little bit out ahead of some, probably most global peers, certainly on integrity and security. And the upside of it is if we do it smart and we do it really well, Canada's banking system will be healthier and safer, and all else equal, that will be a net benefit to the country, and a healthier banking system means probably a more fertile environment for financing economic growth. We can screw it up, though. If we overdo it, if we overreact to certain challenges, we can, and this is what I was saying, and this gets back to Deputy Governor Breeden's point about the stability of the graveyard. Like if we overreact to something, we can do more harm than good. And I think any regulator needs to have that humility and calibrate the positive outcomes you seek against the potential downside costs of what you're doing. Every regulation has a cost. Question for a financial system regulator is the benefits you get to the system, are you confident that they well outweigh the costs? And if you're not, you should probably take a minute and get to a point where you can have that confidence before you do anything. Particularly a system like Canada's, where the track record's pretty good. First, do no harm isn't a bad mantra. So,
just to build on that, then, Peter, how do we mitigate against that risk? And I'm not thinking so much from a regulation point of view in terms of what you do, but from a financial institution now feeling a need to overreact. This is a new regulation. Institutions have to use, it's principles-based. Mm-hmm. We now have to use judgment to determine what that means. I think there is probably a fair amount of concern and worry that you fall short of the threshold. Mm-hmm. And if you fall short of the threshold, what are the implications of that? So how do we mitigate against financial institutions going too far?
Probably three things you can do. The first is hold on to this principles-based approach to regulation. We produce guidelines. We do not produce rules. When we ask institutions to apply those guidelines, we ask them to hold to the principle and adapt their application of that principle to their business model. And we have to be, both institutions and regulators have to be, alive to that opportunity. The second thing is we as regulators just have to count on boards of directors. And my colleague and the Deputy Superintendent, Ben Gulley, gave a great speech a couple months ago about just that. We count on boards to do the work to protecting their franchise values of the institutions that they govern. And there is a line we have to respect where we aren't dictating to boards. We are showing where in our evaluation, policies and procedures may not be up to where we would hope given a principle, but then engage with boards and senior managers in longer term intelligent discussions about the best way to achieve the principle. The role of the board in that is crucial, and OSFI has to know its limits in dealing with boards. And the third is just internally my job really as superintendent, one of them is to make sure that my colleagues are facing out into the risk environment, facing out to their regulated constituents, and having an enlightened view on how to apply our principles-based guidelines and listen to who it affects and change based on good arguments from those constituents. So, the board is one side of the street. The other side of the street is OSFI being diligent and responsible and empathetic in how we deal with our regulated constituents.
So, thank you. Let me, maybe I'll go another level down on board governance. There's been a lot of talk about that, both from the regulator lately in terms of the role of the board, and even as we see new guidelines coming out. Frequently with some of the, particularly with some of these non-financial risks, we're seeing some, reasonably clear expectations of the board in some of these things. Do you think there is a need for any type, just in terms of your dealings, are we in a new era of boards, and does the role of the board need to change? Are the boards fit for purpose today, in your view? These risks are are more complex. I mean, you know, just the reality of it is mostly, we used to deal primarily with financial risks, and if you put some good accounting and business leaders on your board, they could cover them all. But now you've got cyber risk, climate risk, you know, all the integrity and security things. It's a complex myriad of risks that we're asking boards to weigh in on, be accountable for, govern, challenge, et cetera. Have we got it right for the new era of organizations and risks that they face?
I think the basic structure where shareholders hire boards of directors to hire managers, particularly the CEO, and that the board serves as the crucial oversight of the managers they hire. We don't need to change that. You know, there's the old nose and fingers out. That's a pretty good principle to uphold. What's changed is the risk environment, and boards have to change their composition to match up against the risk environment. And so, you know, and we're not, this isn't on OSFI's initiative. It really is on the boards that we work with on their initiative. They're recognizing these risks, and they're bringing in a wider array of members who understand risks and certain risks in a more technical level. So you'll get cyber risk experts or operational experts who may understand issues like AML a little bit better, to go along with traditional creditors who borrow from banks, or traditional financial specialists who understand the economics of banks. You need to broaden your skill set on boards. And then the traditional best practices of boards with the right skill set is fit for purpose, which is poke your nose in and ask uncomfortable questions of management and hold them accountable when you're unhappy with the answers.
Great, thank you. Let me go to a few. I've got many questions here. I've covered a few of them, but let me deal with a couple more. OSFI's scope of oversight has increased over the years. Where would you like to see it go in an increasingly complex environment?
I think this is something we're already trying to correct, but with every new risk that props up that's threatening, we put together a new guideline and we put it out. It's third-party risk management, cyber risk management, integrity and security. Over the last 25 years, I don't think we've decommissioned any of our guidelines or advisories. Well, in November, we are going to announce a first wave of decommissioning of guidelines and advisories that are really no longer relevant. Not a game changer for the regulatory environment. It's the easy part, and we're going to do that in November. And then phase 2 will be looking at the ones that weren't so easy to decommission, but that we'd like to, and try and figure out, okay, well, is this one, do we really need it? If we only need a small part of it, maybe we can fit it into a broader guideline. We'd like to constantly be, as much as we add to our regulatory framework, we'd like to be subtracting from it. And so stay tuned in November. We'll get the first wave done. That was the easy part. And then we'll engage with our regulated constituents on where else we might be able to shrink it. It would be good discipline for us, and I hope over the next couple of years that we turn it into a regular, repeating discipline.
Thank you, Peter. We had a session earlier this morning with Ambassador Rice, and it was a pretty comprehensive discussion about the geopolitical risks that we're facing. And you know, we don't have to look too far to see all of the the implications of that. How do you think about the geopolitical risks from a Prudential perspective in your regulating of financial?
I'm not a geopolitical scientist. I'm not a foreign affairs expert. I'm just a simple bank analyst who's now a bank regulator. But I lived through the fall of the Berlin Wall and the end of the Cold War, and then this golden age of free trade and this theory that free trade, free markets ultimately leads to all nations of the world having common interests. Great dream, might not represent where we are right now today. And so what I perceive is a marked increase in geopolitical conflict. I think we had an example of that yesterday in the Middle East, and we've certainly seen Russia's invasion of Ukraine as another example. And then in and amidst these kinetic conflicts, there are virtual conflicts going on in cyberspace all the time. And a mindset I've asked the boards of directors in the institutions that we supervise to adopt is one of thinking of their institutions as nodes in this virtual system that could come under attack by hostile players. And many of Canada's financial institutions are national champions. And so that positions them as unique receptors of geopolitical risk. And I've asked boards to think about that in setting up defenses to protect their organizations. Is there a big wave of attacks on Canada's institutions that's unique and extraordinary? No. But there is a persistent effort by some actors to attack financial institutions through cyber attacks or other means in order to benefit themselves. And I don't. And in so doing, they risk harming the institutions we regulate. So I've asked boards to think of their institutions as having higher risks that might flow out of this different geopolitical environment, and to think about how to protect their institutions.
Great, thank you. I want to stay on the theme of the regulatory impact of some of the sessions we've had earlier today. And this morning we had a speaker on AI, and one of the comments that speaker made was the pace at which AI is moving relative to the pace at which regulation moves. And that, by the time there's a regulation that relates to something to do with AI, it's 2 years after the fact. They move in days and weeks and months, and regulation does not. So are we, is there a thought that we need to think about regulation differently, or is this just a reality that we're gonna live with?
I think you're right on the in discussing the rate of change in each sector. Regulations do change fairly slowly, and advancements in AI will be probably happen exponentially. Should we speed up the regulatory process for that? Maybe a little, but not really. First, do no harm. AI has very significant risks, but also very significant opportunities. And I do think one risk that we have to accept is we will take a little bit longer to implement regulatory responses to AI. And the risk that comes with that is what you just pointed out. AI could really take off and create risks we don't see, and then create a crisis that will cause us to react to it. I do think right now accepting that risk is intelligent while we begin to develop and build our understanding of the space, and not knee-jerk into reactions that might otherwise harm the development of this technology. I'm not saying it's risk-free. I'm saying we're doing work diligently but quietly to understand it, but it's going to be a while before we develop actual regulations or guidelines on this. I don't think we understand it well enough to do that.
Great, thank you. We also just had a breakout session on open banking, and that's been on the agenda for a while here in Canada, and we do expect we'll receive new guidance on that later this year. I think it's clear that the introduction of open banking introduces new risks to the system. It doesn't necessarily mean we shouldn't do it. We should just mitigate for those risks or work within those parameters. What's OSFI's current engagement on this subject and sort of role and expectations?
So open banking policy is developed by the Department of Finance, and there's been a role sort of stated in the most recent budget document for the FCAC, the Financial Consumer Agency of Canada. So we're in supportive, interested but supportive observers to it. At present, we're not seeing any step change in systemic risk as a result of open banking. If we did, we would make our concerns known. As open banking and the digitalization of financial systems continues to go forward, product design, particularly in funding, will be a very, very important consideration for financial institutions. The traditional stable sticky demand deposit, I think institutions should be continuously measuring how sticky their demand deposits are in an electronic world, and then developing their product in the event that they believe that stickiness is weakening. In Canada, I don't see any evidence of a weakening in demand deposit stickiness. But I know that the institutions looking at open banking are keeping a good, clean eye on that risk, just in case it increases.
Thank you. We haven't talked about climate. Don't think we can go through a session without including climate. It was, maybe it was felt like it was higher on the agenda from a regulatory perspective for a period of time. Where do you put it today in terms of the priorities coming out of OSFI at this moment?
So we certainly made a lot more noise about climate 3 years ago than today because we were in building a capacity to begin to prepare the institutions we supervise to manage that risk. So now that we've developed a guideline, we've developed a scenario testing capability, we've developed regulatory returns for climate risk exposure. So we're through the initial lift. The next 3 years will be much, at least from a visible standpoint, a public relations standpoint, will be much quieter because now we have to do the hard work of implementing B15. Now we have to do the hard work of measuring climate risk exposure through Scope 1, Scope 2, Scope 3 emissions. Now we have to do the hard work of processing regular scenario tests for different climate scenarios. In so doing, we are developing a maturity in measuring and understanding climate risk as a financial risk. We have to advance and mature our ability, as do the boards of directors of the institutions that we supervise. And it's going to take 3 or 4 years. I would equate it to market risk back in the 1980s, liquidity risk coming out of the great financial crisis. There is a multi-year process of just getting smarter and more empirical around climate risk. And that's what we have to focus on. And then that will begin to answer the questions that are more longer term, which is, do we have enough capital for worsening or intensifying climate risk? If not, how's the best way to advance that? If so, well, that's one less thing to worry about. What do boards need to think about in terms of measuring climate risk? And at what point should they disclose it to the market? All those things require a couple of years of green eye shade, nose to the grindstone empirical work to measure the risk more effectively. And it's important. This year, according to the Insurance Bureau of Canada, there was $7.5 billion in natural catastrophe losses. The previous high was $4 billion the year of the Fort McMurray fires. Anyone want to take the over-under in 5 years, whether 7.5 will be the high? I take the over. And so climate risk is first and foremost a financial risk that we haven't fully figured out how to measure and price. That's the job of the next 3 years.
Terrific, thank you. We're just about at the end of our time, so I'm going to leave you with one final question from our participants. Of the top risks banks face, which one is OSFI most concerned about?
Well, we put out our Mount Rushmore, the top 4, which is the one, it's number 1 is still residential mortgage lending risk and the housing market more generally. That's the largest allocation of risk in a bank's lending book is. That has a fundamental link to consumer confidence and consumer spending, which is 2/3 of our economy. So that is I feel like OSFI's been saying this for 20 years, but that is the central risk to our system.
Good to be a consistent regulator.
Yeah.
Peter, thank you very much. Really appreciate you always coming. Thank you for your continued openness and transparency.
Thank you.
Thanks, Peter.
Yeah, thanks.